can't leave. Honestly, those two words are the absolute core of our explainer today. We're going to systematically break down why Palantir might just be, literally, the hardest company in the entire world to replace. And, frankly, that's a much more fascinating investment angle to look at than just asking how fast a tech company can grow.
So hear me out. Palantir isn't expensive. Now, I know exactly what you might be thinking if you've glanced at their valuation metrics lately. But here's the secret. When a company becomes structurally impossible to remove from its clients' daily operations, the whole investment equation shifts. You're no longer pricing simple, straightforward growth. You're actually pricing dependency.
So the absolutely crucial question we have to ask is this: can customers ever leave? That's the real thesis we're exploring today. Not whether Palantir can just keep bumping up its revenue quarter over quarter, but whether its customers are, permanently locked in. Because if they literally can't leave, then what looks super expensive today might actually be structurally underpriced.
Part 1. The government proof.
See, Palantir didn't prove this insurmountable lock-in effect by working with nimble little startups. No, they started with governments. That is the ultimate testing ground where switching costs are undeniably real. When you embed software into incredibly high-stakes areas, we're talking defense systems, intelligence workflows, battlefield decision-making, it fundamentally changes what the product actually is. It's no longer just a simple software tool. It becomes foundational infrastructure.
And how do we define infrastructure here? Well, it's a structural system that isn't replaced easily. Not because it's perfect, mind you, but because removing it creates far more risk than just keeping it. Think about it. Infrastructure isn't judged on having the slickest, most beautiful user interface. It's judged on the immense, terrifying operational danger of tearing it out.
I really want you to pause and just think about this reality for a second. If replacing your software could literally compromise national security, what do you do? Just imagine being a government agency trying to rip out these complex systems while still trying to maintain seamless battlefield logistics. The operational risk is just too astronomical to even entertain.
So it begs the question, is leaving even a real option anymore? Or is the client permanently locked in the second that system goes live? That right there is the first massive signal we're looking at. Palantir isn't competing on having the absolute latest bells and whistles. It is competing on the sheer impossibility of its removability.
Which brings us to part 2, AIP, the lock-in engine. Let's shift gears over to the commercial sector. Now, most people look at Palantir's commercial growth and they just see standard enterprise AI adoption. But honestly, they are missing the deeper structural play here. AIP, that's their artificial intelligence platform, is not just an AI product, it is structurally designed from the ground up as a lock-in replication engine. The end goal isn't selling a flashy chatbot. The goal is embedding the company directly into the very fabric of how a client's business actually runs.
In practice, they use this incredibly specific deployment trap to rapidly embed themselves. First up, boot camps. This gets teams hands-on immediately to build that initial reliance. Next, rapid onboarding, which completely breaks down the initial friction of adopting something new. And finally, real-time operational integration. Guys, this isn't some slow, phased, traditional software rollout. It is a highly aggressive insertion right into a company's daily heartbeat.
And what happens next is wild. Operations completely restructure themselves around the software. They get embedded into the supply chains. They get deep into complex logistics. They wire themselves right into daily decision workflows. Once integration hits those ultra-sensitive, mission-critical areas, clients are no longer just buying software anymore, they are restructuring their entire business around Palantir.
So let me ask you something. If your entire global supply chain, your logistics network, and your real-time daily decisions start running natively on top of Palantir, how exactly do you leave? Leaving isn't a simple technical challenge where you just migrate some data over to a new server. It becomes a devastating operational crisis.
All right, part 3, margins follow the lock-in. Once you fully grasp this deep structural dependency, the financials suddenly make a whole lot more sense. The market loves to cheer for their expanding margins, those highly valuable long-term contracts, and their significantly lower customer acquisition costs, meaning, they spend way less money to get in your clients. Financial analysts absolutely eat these numbers up. But here's the catch. These are just symptoms. They're the highly profitable side effects of a much deeper structural advantage.
The reality is that these metrics, they're just the results. The true driver behind all of this is lock-in. The single unifying variable driving all of this financial success is incredibly high switching costs. It is the very unglamorous fact that their clients are, fundamentally, stuck, which, if you think about it, is absolutely the best possible scenario for an investor.
This structural lock-in creates extreme pricing power, because realistically, where else are the clients going to go? It drastically reduces churn, meaning clients aren't just canceling their subscriptions on a whim because they operationally cannot leave without breaking their business. And it extends the lifetime value, maximizing the revenue from each client because they are integrated for the long haul. Ultimately, this translates perfectly into the profile of a high-margin software monopoly.
So the fundamental question we have to ask inherently changes. We are no longer asking, hey, is Palantir growing fast enough this quarter? The real question becomes, how durable is this dependency? Durability, not just the raw speed of top-line growth, is absolutely the single most vital metric you should be watching right now.
Let's move to part 4, the expectation gap.
There is this massive, glaring disconnect right now between how the broader market is valuing the stock and what is actually happening beneath the surface. The superficial narrative that's currently being priced in is just a simple AI growth story. More clients, more revenue, more AI expansion. But the deeper reality? It's permanent infrastructure. Are they building an inescapable commercial system? Because if the answer to that is yes, you are not looking at a normal software company anymore.
You're not pricing growth. You are pricing permanence. And infrastructure is valued very differently in the market. Palantir might look ridiculously expensive if you're only staring at traditional growth charts, but it might actually be totally mispriced if what it's truly building is a permanent dependency. At the end of the day, the most valuable companies aren't always the fastest growing ones. They're simply the ones that are the hardest to replace.
Which brings us to a final, really provocative thought to end on. Do you believe Palantir can replicate its government-level lock-in in the commercial world? Because if it can actually pull that off, this isn't just a growth story anymore, it's a structural rarity. I'm going to leave you to weigh that judgment for yourself.
And finally, just a quick reminder that this content is for educational and informational purposes only and does not constitute financial or investment advice. This was an in-depth analysis of commercial logic and structural lock-in. Always do your own independent research. Thank you so much for joining me on this explainer, and keep learning.